Cool.
Yes.
All right. All right, let's talk about monetary policy options. All right, so money enters the economy in a process called money creation. Banks create money by making loans of money people deposit in the bank. So if a person deposits $1,000 in a bank, the bank can loan out most of that money to somebody else. That loan will eventually end up in another bank account, and most of that will be loaned out to another borrower. In this way, the original $1,000 deposit leads to the creation of hundreds of additional dollars in the economy. The Fed has three ways to control the amount of money in the economy. The simplest is to change the reserve requirement ratio, the amount each bank deposits that a bank must keep and not lend out to the borrower. Reducing the ratio means that banks can lend more money out. Increasing the money supply, increasing the ratio has the opposite effect. It's rarely used. So if the Fed says whenever there's a deposit into your bank, you can loan all of it out except for 10%. Okay, they have to hang on to that. That's their reserve. If the Fed wants more money out there, they can reduce that to 5% or 4% if they have to. Then that extra 6% goes out into the economy, right, through a loan. Vice versa, if there's too much money out there, they'll start saying the banks have to hang on to 15 or 20% amount of the deposit and only let that much money out. Now, the reserve requirement we don't use very much. The tool's rarely used today. The second tool to adjust is the discount rate, which is the rate the Fed charges on loans to banks and other financial institutions. When the discount rate goes up or down, interest rates for those types of loans go down. Right now, it might be at like 1%, the cost that it costs a bank to borrow money from the Fed. For a while during the pandemic and during the recession, it was zero. And at some points in Europe, the government would pay the bank to take the money. So if the bank wanted $100,000 from the Fed would give them $110,000. Actually, $101,000. I think it was like 1%. But that's another way that the Feds can control how much money is out there, because the higher the interest rates, the less loans people will take out. A drop in the discount rate generally lowers the prime rate, which is what banks give their best customers, their prime customers, the customers that have great established credit. When banks lend money at a lower rate, it tends to increase the overall money supply. Today, the Fed generally does rely on changing the discount rate as part of its policy. So if I can get my auto loan is like 2.6%. And that's really low. It's almost like free money. It's almost like, I still have to pay the loan back, but it doesn't cost me money to have the loan. The Fed's third and most commonly used monetary policy tool is the open market operation, the buying and selling of government securities such as bonds. When the Fed wants to increase money supply, it purchases government securities, it purchases savings bonds, government bonds. It buys the bonds, that cash goes out, boom, it gets spread out in the economy. A bond seller deposits that money from their seller into a bank. Remember, the bank hangs on to a little bit of it and loans the rest out. And there we go again. To decrease the money supply, the Fed sells the securities. They sell the security, that money comes to the Fed that's out of circulation. That's the most easiest way to put money in and out of circulation. Open market operations tend to affect the federal funds rate, which is what interest rate banks charge each other for money. Change in the federal funds rates can also affect rates available to business. Don't worry about the questions, but there are some questions if you want to look at them. That's one of our lectures. Let me stop the recording real quick.